Hi everyone, welcome back. In this video, we're going to talk about two popular investing strategies that many of you have probably heard before: dollar cost averaging and buying the dip. These two strategies are very different in terms of execution. So let's dive in and see which one might be better for you. Number 1, dollar cost averaging, or DCA. With this strategy, you invest a fixed amount of money at regular intervals such as $100 or $500 every week or every month. The goal is to smooth out the impact of volatility by buying more shares when prices are low and fewer shares when prices are high. Without trying to time the market, your average cost per share will gradually decrease over time. Let's take a look at an example. If you invest $500 into NVDA every month, here's what your results would look like. In January 2023, you bought 0.48 shares of NVDA when the stock was priced at $263 per share. Then in February, you bought 0.41 shares when the stock price dropped to $239 per share. By March, NVDA was down another 13%, and now you're buying 0.57 shares with your $500 investment. This pattern continues throughout the year. As you can see, you end up buying more shares when prices are low and fewer shares when prices are high. So what's great about dollar cost averaging? First, it removes emotion from investing. If you are the type of investor who tends to panic sell when markets drop or get FOMO when markets soar, this strategy may help you stay calm and rational. It can also work well for long-term accumulation. If you have years or decades until retirement and can stay committed to your investment plan, you'll likely benefit from DCA. Plus, it reduces the risk of investing a lump sum right before a downturn. We've all seen headlines of people investing their life savings right before a crash. It's easy to think you're being smart and timing the market perfectly. But in reality, even professional investors struggle to do this consistently. With DCA, you and have to worry about investing everything at the wrong time because you're respreading out your investments over months or years. And finally, it's simple and straightforward. There's no complicated charts or technical analysis involved. Just invest regularly and stick to your plan. Of course, dollar cost averaging has some drawbacks as well. First, you might miss out on bigger gains if the market trends up steadily. Let's go back to our previous example with NVIDIA stock. Had you invested $13,000 into NVIDIA at the beginning of 2023 instead of dollar cost averaging, you would have made almost double the amount of profit. And second, it can be challenging to keep investing during downturns. When the market is falling, it's easy to become discouraged and stop investing. After all, why would you want to buy something that's losing value? But if you're a long-term investor, it's important to remember that short-term fluctuations are normal and that you should keep investing consistently. Now let's move on to the second strategy, buying the dip, or BTD. Unlike DCA, BTD involves holding cash and only investing when the stock price drops by a certain percentage or after a market pullback. The idea is to maximize returns by buying at lower prices. But how do you decide when to buy? One way is to set a percentage drop from a recent high. For example, you might buy Adobe stock if it falls 10% from its recent high. Another approach is to wait for a market pullback. For instance, if the S&P 500 drops 5%, you could start looking for buying opportunities in individual stocks. Let's take a look at how buying the dip works with Adobe stock. If you buy the stock at its recent high of $540 per share and it drops 10%, you'll be able to purchase it at $486 per share, assuming the stock price stays the same. You'll be paying $54 less than the recent high. But when should you start buying? Common rule of thumb is to wait for a 10% drop from the recent high. That means if Adobe stock falls to around $486 per share, you could start adding to your position. However, there's no one-size-fits-all answer. It depends on your personal preference, time horizon, and risk tolerance. Some investors might be comfortable waiting for a 20% drop, while others might be more willing to jump on a good deal when they see one. Here is an example of what your trades could look like if you were to buy the dip by a DBE stock at 10% intervals. On January 26, 2023, you could add 486 shares of Adobe when it dipped to $540 per share. By May, Adobe was trading at $512 per share, so you add another 48 shares to your position. In July, you add another 43 shares when the stock dipped to $486 per share. And you continue this process throughout the rest of the year. What's great about buying the dip is that you can potentially make higher returns compared to dollar cost averaging, especially if you time it well. It can also feel psychologically rewarding to get a bargain and see your investment grow significantly in value. On the other hand, buying the dip has its drawbacks as well. First, it requires timing skill. Dips can keep dipping, and you don't want to keep chasing lower prices. If you're wrong about the stock's future prospects, you could end up with a losing investment. Second, you might sit on cash for long periods, especially if the stock keeps climbing. If you're waiting for a 10% drop but the stock keeps going up, you could be missing out on potential gains. Third, emotional bias can make you hesitate or buy too early. It's easy to feel like you're getting a great deal when you buy at a 20% discount. But you might be paying more than you should if the stock price keeps falling. Which strategy is better? The truth is, it depends on your personality, time horizon, and current market conditions. Dollar cost averaging works well for long-term investors who prioritize consistency over maximizing returns. It's a great option if you do and want to spend much time thinking about investing and can stay committed to your plan through thick and thin. Buying the dip, on the other hand, is better suited for active investors who are comfortable with timing the market and taking on more risk. It's also a great option if you're looking to maximize returns and don't mind holding cash during downturns. Many disciplined investors take a hybrid approach. They keep investing a fixed amount monthly into their main holdings via dollar cost averaging. They keep a small cash reserve, 5 to 15% of their portfolio, to deploy opportunistically when there's a significant market pullback or a stock-specific drop they believe is temporary. This allows them to enjoy the benefits of both strategies without sacrificing too much. Remember, there's no one-size-fits-all approach to investing. What works for one person might not work for another. Consider your own situation and choose the strategy that aligns with your goals and preferences. Don't be afraid to experiment and find what works best for you. If you enjoyed this video, please consider subscribing and hitting the like button. Thanks for watching, and we'll see you next time.